started. So for those of you who have not joined us before, we will be having a question answer at the end of this presentation. So throughout the presentation, if you have any questions, please go to the bottom of your screen. You will see a chat box as well as a question and answer box. This is where you will be putting your questions for the end of the presentation. If we cannot get to all of your questions due to time, we will be recording this live session and posting it on our website a week from today. So let's get started. Hello all and welcome to ERP Fixers Ask a Fixer webcast. I'm Jess, your host with ERP Fixers, and today we'll be talking about variance analysis and SAP Controlling presented by John Jordan. Next slide, please. So what is ERP Fixers? We connect you with SAP experts to obtain quality immediate solutions for your SAP systems. We consist of thousands of SAP freelancers globally in all SAP modules who are ready to help and assist you with their knowledge in SAP. We offer an online platform, SAP optimization assessment, material ledger, S/4HANA transitional roadmap, and cost transparency reports. For more information, please visit our website at ERPfixers.com. Next slide, please. About John Jordan. He's the founder of ERP Corp, which provides expert SAP consulting and training. He's the author of 3 SAP Press books, including Production Variance Analysis and SAP Controlling. And this webcast is a launch for our SAP Controlling Conference, which will be held September 20th through the 23rd in 2021 in San Diego, California. If you'd like more information, please visit controlling.erpcorp.com. If you register by April 30th, you get the early bird discount and save $200. Attendees today can use the coupon JJ100 to save an extra $100. Next slide, please. So I'm going to go ahead and pass this along to John. Thank you very much for presenting today, and we're looking forward to hearing your presentation.
Thanks so much, Jessica, and thanks very much to ERP Fixers as well for hosting this webinar. I appreciate the opportunity and welcome everybody. We've had a record number of people register for this webcast. It's great to see the interest in some of the basics of SAP, and this is the basics of SAP Controlling. So it's a great opportunity to review the basics or to learn the basics. So as we proceed today, I encourage interaction, and by interaction with Zoom, we can try typing in the chat box and making it for everybody to view. I haven't done this before, so maybe we can try it and just see if it works, and we can test that. But if you just type in the chat box, what city are you presently in, so we can get it for everyone to see and see how that works. I think we've got a fairly international audience here today. Let's see if I can bring up the chat. Okay, so I can see we've got some chats there already. And can you type in the city that you're from? Okay, there we go. Toronto, Canada. Thank you. India, Mumbai. Great to see. Thank you for joining us. Pakistan, Plymouth, Helsinki, Finland. Welcome. Haywood, California, Santa Cruz, California. So we, in fact, do have a international audience, and I think the chats for everybody to see works. So what I wanted to experiment with that, because when you're thinking of a question to ask, you're actually learning some of the material, but you're also interacting with other people to see, oh, that's a good question, I didn't think of that, and vice versa. So let's try that. And we're getting a lot of messages come through here. I think we've got about 100 people logged in today, so we've got a really good turnout. So welcome, everyone. I might actually send it after the webinar. I'll send out and let everybody know where everybody came from. Saudi Arabia, Melbourne, Denmark. Great, welcome. Okay, so let's get started. That seems to be working. Okay, I like work variance analysis myself because every situation is unique and different. You'll never have one situation step the same generally. And the way that you work through all the different situations in various analysis is to understand the basics. And so that's what we're going to do today, is cover the basics. If you think of a question after the webinar that you wanted to ask me, just shoot me an email, no problem at all. So let's get started. So the first thing we're going to do is cost objects and what cost objects have to do with variance analysis in the first place. So the other thing I wanted to mention is that I learned variance analysis originally about 20 years ago in Sydney when I was attending SAP training as a junior consultant. And as they're presenting all this information on the slides, I thought that's interesting, but that's a lot of information, way too much information to learn. So I started taking notes and I started to think of a flow that pulled all the different pieces together, and I wrote that down. And in that way I learned variance analysis, but I also had the flow chart after that I still use to this day. And if you saw my photo on my LinkedIn posting, that whiteboard flow is the same flow that I developed 20 years ago. So today we're going to talk about some of that flow, and specifically the cost objects is the first thing we'll discuss. About 15 years ago, SAP Press approached me and they said, listen, you're doing these presentations on product costing and you're doing these articles on product costing, but we've got no books on this at all. Would you write a book for us? And I said, sure, what do you want the title to be? And they said, well, you're the expert, you tell us what the title is. So I thought, well, it's too big a topic to write my first book on the whole of product costing. So I picked variance analysis. And as it turns out, that was a good choice. And that's the book you can see in my background, conveniently placed. The nice thing with variance analysis, if you follow it through from start to finish, it follows the flow of product costing from start to finish. So by studying variance analysis, it's a very good background to understand product costing. So as it turns out, the square is the most important object in SAP. It occurs everywhere in SAP, in every module. And the reason is because a company's purpose to exist is to add value and to produce something of value. And to add value, you generally incur a cost to manufacture something or to research something. And those costs are collected on a cost object. And the best way to represent that cost object is a square, believe it or not. So if you remember this square and nothing else from this presentation, you'll be a long way ahead of most people. So the thing with the square is it has 2 columns and 2 rows. And could I just ask a quick question, if you can answer in the chat, what do the 2 columns represent and what do the 2 rows represent? Let me see, I can see the notes here starting to come through. This is a good, so we've got some good ideas here. Costs, revenues, margins, variance. The answers are all in there, which is great, thank you. This is good. So keep typing in your chats. I'll move that chat box over there. So I've actually, oh yeah, debit credit, that's the one I was looking for. Thank you. Standard and actuals. Actual quantity, actual price. These are all correct. So thank you. And this is the answer. Well, my answer. The columns represent plan and actual, and the rows represent debits and credits. And in fact, as it turns out, the reason that a cost object exists, its sole purpose to exist, is to receive costs and to send costs and to analyze costs. And you analyze costs at the bottom rectangle, which is the variance, which is the difference between the debits and the credits. So now we start to, as we discussed the square, we're going to analyze product costing, as it turns out. So thanks for your answers in the chat. So let's analyze what's really in the square. I've given you some answers here in the debit row. A production order receives debits in real time when we issue materials to the production order, when we confirm activities from a cost center to the production order. And in fact, when we confirm activities, we're actually transferring costs from the production cost center to the production order. We're transferring the activities to the product cost in real time. The overhead can be in real time. It can be at month end when you calculate overhead to move some more of the costs through from the production cost center to the production order. And when we add the cost to the production order, we are adding costs to inventory indirectly. So let's discuss that. And by the way, this real-time postings in SAP were actually called a long time ago simultaneous costing, because they're happening in real time. I haven't heard that term for a long time, but if you write that down, it's something to compare simultaneous costing compared to cost estimates. So then the next question is, well, what do we do with the debits? We compare them with the credits. So how do we get the credits on the production order? We get the credits on the production order when we do the goods receipt into inventory from the production order with the assembly that you're manufacturing, which is the whole purpose of the production order. So if there's a difference between the debits and the credits, that's the variance that we're about to analyze. So we know where the debits come from in the production order, but where do the credits come from? And the answer is, can anybody give me the answer to that, by the way, in the chat, just quickly? What calculates the credits? I haven't given the answer to that yet, so some people will know, I'm sure. I'm just reading the, yeah, standard cost by quantity. That's exactly right. Thank you. Standard cost estimate. Some people are on the ball here. Thank you. Yeah, revaluation of activity price. These are all correct. So I'm going to present the basics right now. And if you understand the basics, you can figure everything else out. So let's now analyze the credits a bit more. So the debits happen in real time, but the credits, the planning for the credits started 12 months ago. If we're doing the costing today, when we created the costing run for the materials and inventory, that happened just before the end of last year. So it's when we created that costing run, the cost estimate goes to top level assembly, and the first thing it does is work its way down through the BOM to the purchased items. And when it gets to those, and this isn't material ledger, by the way, this is the cost estimate, goes to the purchased items at the bottom of the BOM, and then it goes to the purchasing info records, retrieves the purchasing price that the purchasing department quoted, what the price would be when we purchased them next year. The cost estimate retrieves that, works its way up through the BOM, and brings the material costs of the assembly into the cost estimate, and that's called the material cost component. The cost estimate also does the same thing with the routing. It determines the activity quantities and the activity price, and determines the activity cost, which is the second cost component. And the cost estimate also accesses the costing sheet, which determines the amount of overhead to add into the product. So there we have all the three major cost components into the cost estimate. So the question is, if we went to all this problem to create all this work, to create the BOMs, to create the routings, to create the costing sheets, we went to all that trouble and we estimated what the cost was, how can in the space of 6 months there be a difference to what we actually issued to the production order to what the cost estimate planned? And the results of that are actually variance analysis. Variance analysis categories conveniently analyzes the cost for us so that we can do our own analysis and figure out where the issue occurred. So we'll talk about that in just a minute in more detail. So we create those cost estimates for the assemblies. And then when we do the goods receipt today into production from the production order gets a credit for the value of that standard cost times the quantity that we did the goods receipt for. So at the top of the square, which is the cost object, we have the debits for materials, activities, and overhead real time right now. And we compare that with the value of the cost estimate in the goods receipt. And then the difference is the variance. So the question is, why is there a variance? And you'll notice, as we're talking about cost objects, it seems like a simple concept that's a square, and it is theoretically, but there is an entire module in SAP called Cost Object Controlling. And what that module does is exactly what we just talked about right then. This square is the cost object, and the controlling part is analyzing the variance of the square at the bottom. There is also another entire module called Product Cost Planning, which is what we just discussed when we created that cost estimate. And the cost estimate went to the assembly, went down through the BOM, went to the purchased items, brought the material cost all the way up through the BOM, and then we ended up with the total material cost and only the total material cost for the assembly, and the same with the activities and the same with the overhead. So we've just discussed two complete modules in SAP. So you can see there's a lot going on in the background here, but if you can remember these basics of what product costing is all about, if you work your way back to the square, we can figure out what the problem is. So let's do that again. Now, we were trying to figure out how could the material cost change right now from what we predicted it would be 6 months ago. So when we do variance analysis, it very conveniently tells us that there was an input price variance. It doesn't give us the answer how it occurred, but it tells us where to look. So we can talk to the purchasing people and discuss with them, how did the price change from 6 months ago to now? Now, that's an analysis project in itself. It can be. You might be using moving average price for your purchased goods, and that will change all the time. So that could be a reason. You might be using standard cost estimates for your purchased materials, and maybe another cost estimate was released after the initial cost estimate in the costing run last year. Can anybody give me another reason why there might be difference between the actual debits and the actual credits to the production order? Will I have a drink? I've got some chats coming through. Thank you. A lot of chats coming through. Yes. Very good. We've basically got all our variance categories there, so thank you. So let's go through these, all these comments. Thank you. So what are the other reasons for a difference? We discussed there's an input price variance. There can be an input quantity variance. So the BOM said that we would use 10 of this component, and instead we lost 2 along the way. So we had to issue another 2 to the production order. That's immediately going to give us an input quantity variance. So there's 2 of the input variances, input price variance, input quantity variance. So what's the other 2 input variances in the chat? Just quickly coming through. Yes, very good. The resource usage variance. That sounds complicated, but it's not at all. The resource usage variance is if we said we were going to use 10 of component A, but as it turns out, we ran out of component A, so we have to use component B instead. So we substituted component B instead of component A. And that sounds similar to input quantity variance, and it is, but it's significantly different because we plan to use component A, and we actually used component B, which we didn't plan to use, and all that information is recorded in SAP. So there you have the three most important input variances: input price, input quantity, and resource usage. Now, SAP is telling us by default that these are the three most important variances. And what it says, if the input variances don't fall into these three categories, they fall into, by default, remaining input variances. The same concept applies to the output side, although the input variances are way more common. This presentation will be available as a recording on ERPfixers website, and I'll leave Jessica explain those details to us at the end. So let's quickly talk about the output variances. Yeah, you can only see the cost object slide. That's right. I'm deliberately not going through the bullet points, but let me go through some more for you. So this is the next slide. The thing with variance analysis, it's all about cost objects. I do have the variance categories in following slides, so let's go through some of those. Okay, so then after we've finished talking about cost estimates, cost objects versus cost object controlling, the next is cost estimates, I'm sorry. So this is just explaining in the bullet points what I just explained. And I'm hoping by not going through the PowerPoint slides that you'll be taking notes, because it's by taking notes that you'll learn. But let's see what you learn. How many input variance categories are there in the chat? If you can please just answer that. 9, nice guess. 3, well, 3 is close, but 4 is the correct answer. Now, for the person who said 8, that's correct in that there are 4 input variance categories and 4 output variance categories. So in total, there are 8 variance categories, 4 input and 4 output. That is correct. So let's quickly discuss now one of the output variances. I could show you the slide on that one, just to show you I have prepared some slides. So there's the 4 input variances that we just discussed. And I don't think we even need to go through the examples that I've given, because we've just discussed them, and you'll be able to access this presentation after. Input price variance: a component is valued at $10 in the costing run. The price changes, and now it's $11 when it gets issued to the production order. So there is a $1 input price variance. Resource usage: the key word to remember with this is it's substituting components. You ran out of a component, and because of that, you had to fly in another component at double the cost. That difference can be significant. There's an example. Input quantity variance: we lost a couple along the way to the production line from inventory, so we had to issue some more. So it's input quantity variance. And the remaining input variance is anything that SAP can't assign to those previous 3 input variances. And I'll let you read the example here. So it's to do with slight differences in overhead. The overhead changed because the input quantity changed or the input price changed. So there is no variance category just for overhead, of course, so that gets put into remaining input variance. It makes sense. So let's have a quick talk about output variances. So what is an output variance? Obviously, an input variance is your issuing costs to a production order. Now, the production order then produces something, but it produces something at a different cost to what the cost estimate said we produce it, but it wasn't due to the input. The most common output variance is the lot size variance, I found, and we'll open that up to chats in just a minute. But the lot size variance is due to when you produce 100 of an item, you have certain fixed costs like setup costs and teardown time. Now, you create the cost estimate based on 100, and you spread the setup costs and teardown costs across 100. But if you then produce 10, you're spreading those fixed costs against a smaller number, so you actually increase the cost per item if you produce less of a number than what you estimated you would, and you in fact do, clearly. And SAP lists that as a lot size variance. That applies to manufacturers who produce physical assemblies, and it can occur a lot, and it's not immediately obvious that that can be occurring, because you might just be getting less customer orders, so you're producing less, obviously, but because you're producing less, you're actually spreading your fixed across less items. Let me open up my chat here to see. Can I share the presentation at the end of the session? Well, I'm sharing it now. I'll see what I can do. Rounding off differences, somebody mentioned. Yes, that's true. Now, that's a good point. I'm not sure which category that goes in. That might be remaining variances, but that is true. Thank you. Let's have a look at some more. Output price variance. I've never actually seen this in real life, but theoretically it is possible. Lot size variance, I just discussed. This is common for manufacturers. Mixed price variance, if you're using mixed cost estimates, you will definitely have mixed price variance. By default, you will have mixed price variances, which is a good reason not to use mixed price cost estimates, but you absolutely can. And it is absolutely standard SAP. And the 8th variance is the output remaining variance. Anything that SAP can't figure out where it should go, it puts into the remaining variance. Let me check the chats here. A mixed price cost estimate is only possible if you use the same material SKU. Maybe, it depends. I won't go into detail on mixed cost estimates just at the moment, but the theory is that there can only be one standard price for an assembly. You can't have multiple standard prices. So if you've got different sources for your assembly, if you're buying some assemblies from external vendors and you're manufacturing some of your own assemblies, so there's different costs of manufacture. So there's two approaches. You can either say that, okay, when we manufacture an item, it's more efficient and we'll try to manufacture it, and the standard costs will be based on internal manufacturing. Any extra costs coming from external vendors will go as a variance, because we should be really increasing our internal capacity to manufacture. A mixed price cost estimate says, no, I want the inventory valuation to represent the valuation of the average of the external vendors and the internal manufacturing cost. So by definition, when you do that, you will always have a mixed, let me go back to that slide, sorry. By definition, you will always have a mixed price variance, which is a disadvantage of using that. Okay. So are there any more questions? That we've just covered the 8 variance categories, but you can see that the variance categories themselves don't mean anything unless you know the basis of the cost object and how the cost object got the debits and how the cost object got the credits. So it's only when you understand that theory do these categories mean anything. But when you do understand all those concepts, then when you're wondering why you have such a large variance on your production orders, you can then investigate what's causing the variance. Any more questions on the individual variance categories? Okay, so there's a question on mixed costing, and I'll go through quickly. I don't want to spend too much time on it. Now, here's a good question I'll go to first. Our business wants to recost every month. That comes up a lot. If I've got a lot of variances and I'm costing every 12 months, why don't I just do the costing run every month? I'll reduce the variances, right? Yes, you will. But there's a trade-off. Yes, so you've given the answer right there in this chat. Thank you, Douglas, that the whole point of standard costing is to hold your cost at standard so you can measure the variances, so you can figure out what's causing the variances and try and reduce them. If you recost every month, you reduce your variances, which you may need to do. There's no problem with that. You can in standard SAP. However, is that what you really want to do? That's all. We're doing costing run every 3 months. Sure, that's a good compromise, probably. As long as you're analyzing the variances and continually trying to reduce the variances, that's okay. In some industries where the prices of the components vary a lot, like in electronics, it may be completely reasonable to have a costing run every quarter or every month, as long as you understand what's happening with the variances. That's okay. You can't do a costing run any more than 1 month, obviously. That comes up occasionally. The objective is to minimize variances. That's correct. That's a nice summary, actually. By analyzing the variances and reducing them, you're improving your production efficiency. And that is one of the goals for sure. Is it, hold on just a minute. As long as identified changes are to quality and value structure is classified. Yeah, there's a lot in that question, but yes, the idea is that analyzing the variances is the start of the journey. It allows you to know where to start investigating. You start investigating why was the purchasing info records wrong from 6 months ago? Why are we producing less quantity? Why are we manufacturing in quantities of 10 instead of quantities of 100? You need to start investigating that. Well, our customers are ordering less, so maybe we need to modify our manufacturing process to make it more efficient, that type of thing. Those are the questions that you want to answer as part of variance analysis. So thanks for those questions. They're very good questions there. Okay, we've got about 10 minutes more before we go to general Q&A. So let's go through some more slides. And Jessica, if I miss a question in the chat, please let me know. I just wanted to cover variance calculation is a month-end procedure. And there are some requirements to be able to calculate variance on a cost object. On a production order, when you issue materials to production order and you haven't done any goods receipts, those costs are removed from the inventory, from the component inventory, and they're sitting on the production order. It's only when you do the goods receipt that you put those costs back into inventory as part of the assembly. So as month end, when you calculate WIP, if you haven't had any deliveries from the production order, the cost will be calculated as WIP. However, in the next month, if the status of the production order is now delivered, you will cancel WIP and you will calculate variance. So it's important to know that when you're doing the variance calculation at the end of the month, the production order status is very important. So to calculate variance, you must have done a delivery from the production order into inventory. I was thinking of a fun example of this, that we are all cost objects ourselves, individually. We are cost objects. And the reason I say that, when you think about it, is at the end of this year, when I'm planning my budget for next year, my personal expenses, I'm going to estimate I have $100,000 cost next year. It's expensive to live in San Diego, right? And so the next thing I would do as a consultant, as a rule of thumb, I have about 1,000 hours that I can consult for each year, rule of thumb. So therefore, if I'm available for consulting for 1,000 hours, if I want to pay for my $100,000 expenses, I would have to charge $100 an hour. So it's another angle to look at how you calculate your activity rate and how you calculate your activity quantity. My 1,000 hours is my 1,000 hours available. That's my capacity, my activity quantity capacity. My activity rate, maybe I can get $100 an hour, maybe I can get more, maybe I can get less. But if I calculate my budget, if I'm a cost center and I'm going to have debits of $100,000 and I can earn $100,000, I'm good. I got no debts, I got everything's equal, right? However, if I don't get to work 1,000 hours, if I only get to work 500 hours, I'm going to have a balance at the end of next year of about half the cost. So I'll have a debt of $50,000. So it makes me an unhappy cost object. But it just gives you an idea that how real life this can be. You can consider these concepts are real. So I thought of another fun example, if we've got time, yeah. So if we had a baby next year, haven't had a baby this year, have a baby next year, is that a variance? Well, it depends. Say the baby costs $50,000. If I planned that baby, I would plan $50,000 expense. So in that case, I would have an extra planned expense of $50,000 and I would have no variance. Everything's good. However, if the baby was unplanned, I would definitely have $50,000 extra expenses that I didn't expect. So in SAP, that would help us, I guess, understand where those extra expenses came from. But you can get the idea that this isn't necessarily all theoretical. It can be real life, and it is in fact real life. All these costs, all these plans can be real life. And if you think about it, the developers in SAP had a sense of humor. They might have, because when you deliver a baby, when a baby is created, it's delivered, right? When you finish a production order, when the status is delivered, you're finished with the production order, and you can calculate your variances. So it's just another way to look at it. I just wanted to reinforce that the status of the production order is very important in variance calculation and not to be forgotten. It has to be delivered to be able to cancel, whip, and calculate variance. Okay, so I've got a question here. What's the benefit implementing material ledger for costing and variance analysis? That's a great question, and something that I'm not. That's another webcast, and thanks for that. But obviously, material ledger adds a lot of extra functionality. All I'm saying is that with basic, if you understand cost object controlling and product cost planning fully, and you examine your variance categories fully, and you take steps to improve the situation, you've got a lot of information there. And I think it would be good practice to do that before you implement material ledger. And it's definitely worthwhile to implement material ledger in addition to this, but don't think that material ledger will solve all your problems. It will definitely help, and it can help a lot, but you've also got a lot of functionality in addition to material ledger with standard month-end processing. Has anybody else got any comments on material ledger now, apart from being mandatory with S/4HANA? My comment on material ledger is that you're never really talking about just material ledger. You're talking about possibly actual costing in addition. We know that material ledger is now mandatory with S/4HANA, but actual costing isn't mandatory. So it's a good question, by the way. But even with material ledger, you still need to do all the month-end processing. You need to calculate WIP, cancel WIP, calculate variance, settle. You need to do all these things in addition to material ledger. Material ledger doesn't relieve you of that responsibility. So you still need to understand everything that we've discussed today. You do need to, you have a requirement to understand everything that we've discussed today. Let's have a look what other slides I've got here. The variance results. After you use calculated variance, SAP has a results screen, and you can sort. I would sort the variances in the order of the top variances down the other way, descending and ascending, and that gives you the problem production orders, and you can investigate those production orders that have got the largest positive and negative variances. I've got about 3 minutes left here before I hand over to Jessica. If you've got any more questions, please put them in the chat. I'll go through the slides. Variance messages analysis can take a lot of work to initially to work your way through these messages. I've just given a small explanation in this slide. And this is it. That's my slide on margin analysis. I think everybody knows by now that with previous to margin analysis, with costing-based COPA, you mapped variances, each variance to an individual value field, and you got to analyze it in COPA, which is great. And you can still do that. And I think most companies still do that. However, with margin analysis and S/4HANA, when you transition to margin analysis, you'll map your variance categories to individual GL accounts, standard SAP. And as far as I can tell, that works great. And it gives you extra functionality because you're now using Universal Journal. If you're using margin analysis, you are using the Universal Journal by default, and that gives it a lot of power. Just before I go into ERP Corp, let's look in the chat. Can you map your variances by cost component in S/4HANA? Yes, I just explained that. I believe you can map your variances to individual GL accounts in standard configuration. It's fairly similar to what you did before to costing-based COPA. And in fact, I believe you can have both costing-based and account-based in S/4HANA. But the question is, if you're setting up correctly, do you really need to do that? Maybe initially, but definitely you ought to be heading towards using just account-based COPA and margin analysis. There's a question here. Most probably everyone's issue that while doing variance calculations, if orders are huge, it takes time to execute. Any suggestions with improving the performance of the variance calculation? You know, that's a good question. There's more to that than meets the eye. And one of the answers can be to delete some of your older production orders through archiving is one answer. There can be many reasons for that, but your system might be, your system is forced to process every production order that is not closed in month-end processing, so that can be an issue, and it's a good question. And of course, with S/4HANA, you'll speed it up as well. Does variance analysis work the same with product cost per order instead of using product cost collectors? It's very similar. It's a very similar concept. And I discussed that in my book quite a bit. Okay, so let's move on. We're getting towards the general Q&A. I'll hand it over to you, Jessica, in just 1 minute. I just want to discuss ERP Corp, I've started a new subscription-based learning where I'll answer any questions you like for $1 a day personally. And I am in fact doing that, and it's working well. We're holding the conference, the Controlling Conference this year in San Diego in September. As of about a month ago, that wasn't the case, but in the last month, there's been a lot of developments, and we are getting a very positive response to the conference this year, and we will definitely be holding the conference. And I encourage you to register for the conference during this month. We've got an early bird special. You save $200 if you register by the end of this month, and if you use JG100, you'll save $100 with that coupon. So join us in San Diego this September. It's a lot of great networking. We have a lot of great speakers, and they will mostly be attending this year, and looking forward to it. And I'm looking forward to meeting you in September. Feel free to email me any questions that you've thought of after this presentation. I've got just another chat here. Hold on just a minute. We'd love something with allocations, sure. I believe there is a presentation on template allocations at the conference this year. If there isn't, I'll make a note of that. We definitely have had at all the previous conferences, but I'm pretty sure we will. Is the conference online? Probably not at this stage. We're really scrambling to get up and running in person. I mean, it may be possible. We will definitely be recording more sessions this year, but I'll keep you posted on that one. That's a good question. Thank you. So at this stage, I will hand over to Jessica. I think, is that appropriate right now, Jessica, for me to hand over to you?
Yeah, whenever you're ready.
I'm ready.
Okay, I've got one more question. Let me go ahead and just record that.
Sure.
So thank you, John, for presenting with us today. For those of you who were not at the beginning of the presentation, we will be posting all of your questions with your answers on our website sometime next week. So if you do not have your questions answered today, don't worry, we will be reposting this. Okay, so let's get into the end of the Q&A. So first question is, what is the purpose of a cost object?
Okay, that's a very good question. And we did cover that early on in the presentation, but, and I'll answer that right now. The purpose of a cost object is to receive costs, to send costs, and to analyze the balance of the costs. At the most basic level, that's the purpose. And cost objects occur everywhere in SAP, by the way. I can give anybody a challenge right now. If you can think of a module that doesn't have cost objects, please answer it in the chat right now, because there's not many, if you really think about it.
The next question is, what is the difference between input quantity and resource usage variance? They seem similar. Okay.
Could I get some answers to that in the chat? Because we definitely covered that during the presentation. Let's see if we can get some answers in the chat. Difference between quantity and resource usage variance is a good question. Okay, ABAP does not have cost objects. Well, okay, but ABAP is not a module either. So the input quantity variance is where we planned a quantity of 10. Instead, we issued a quantity of 11. And so there's an input quantity variance of 1. The resource usage variance is if you plan to use component A and instead you substituted component B because component A wasn't available. That's not a quantity variance, that's a resource usage variance due to a substitution. And you need to know the reason why the substitution occurred, which is the reason that it's a different variance. I've got an answer here that input quantity is when planned quantity differs from planned quantity. That's correct. and had somebody here said that FI doesn't have cost objects. You know, you might be technically right, but I did forget to mention today that costs make their way into controlling from FI postings. So when you do an FI expense posting, if you don't have a cost object, you'll get an error. You have to attach the cost object. So I'd argue that FI is very closely related. FI expenses are very closely related to cost objects, but it's a good answer. Okay, Jessica.
Sure. When does a production order receive the credit?
Now, I expect some answers in the chat. When does a production order receive the credit? We covered that in some detail today. If you don't know the answer, just type anything in, it doesn't matter. The wrong answer is no answer. If you have a go at answering, you've learned something by just typing in goods received correct. Production order confirmation, the production order receives a debit, not a credit at the confirmation, but I'll accept that as an attempt. Goods received into inventory, correct. So yes, exactly right. Delivered to inventory, and it gets the credit from the cost estimate, right, of the finished good that's in inventory. Everybody's learned that. Very good.
Okay, and then when does a production order receive materials debit?
Okay, somebody want to type in some answers to that in the chat? I actually used a word for that you might not have heard before. You'll get bonus points if you mention the word that I said for that type of costing, where you issue the materials from inventory to the production order. And in fact, you do debit the production order when you do the activity confirmations. It's not a credit, that is a debit to the production order. Backflush is something else. So these are all good answers. The answer to the question, as I mentioned very briefly, is simultaneous costing. And that means that you're issuing the cost to the production order real time when you issue the material components to production order, as opposed to creating a cost estimate, which is creating your planned costs 12 months ahead of time. That's the idea. The goods issues to the production order are simultaneous costing because they happen in real time. And
okay.
Still getting some questions. Go ahead, Jessica. Have I got any more Q&A questions there?
Yeah, most of the, if you did not get your, here we go, here's a new one. Is it possible to capture actual component scrap?
Oh, good question. I didn't talk about scrap much. Is it possible to capture actual component scrap? Of course. I'm not sure, but where is the question coming from? You're having difficulty capturing component scrap. And by the way, component scrap is component scrap is input quantity scrap. It is input quantity variance. If you have an input quantity variance, you probably have actual component scrap. So they're closely related. We didn't talk about scrap, but of course, scrap is related to everything we just talked about. It's a sort of a subcomponent within product costing. Good question, though. Jessica, I'm seeing 13 Q&A questions here. Oh no, that's something else. I got you. That's
I'm trying to record them. They're just shooting up really fast.
I know, no, it's good to see.
So here's one I don't believe you've answered, and it's, does the new costing model in S/4HANA display marginal cost per unit using actual settled cost of an order, or does the data model need an enhancement / customization?
Wow, that's I'm just trying to find the question.
It's going to be in the very bottom of the Q&A, John.
Okay, gotcha. Okay, I've got it. Thank you, anonymous attendee. All right, there's a new costing model. I didn't know there was a new costing model, but anything's possible. And I just wanted to also say, when I'm answering this question, that everything that we've discussed today, those basic concepts all stay exactly the same with S/4HANA. Except, of course, with mapping the variances to margin analysis. Everything else applies exactly the same as far as I know, unless somebody has got an example of something that's not, but I'm pretty sure it is. That last question, I'll have to research that a little bit, if that's okay, and I'll get back to, if the anonymous attendee can send your email address directly to Jessica or myself, I'll answer that a little later. Here's a good question.
Go ahead, John.
No, you go ahead, sorry.
So we will, I am recording these questions, so this will be, I'll send these over to you, John, so you have them, and then we'll post these on our website.
Of course. Thank you. What should the statuses of a production order be to calculate variance? Well, I answered that a couple of times during the presentation, but it is delivered. And you can remember that by the baby example. I put that in there, deliberately. You remember the status of delivered, that cancels with and calculates variance. There is something else. I've quickly got 1 minute to explain. Remember back at the start, I said the cost object had 2 columns, one's plan and one's actual. And somebody said there's another column, target, and that is correct. You can only calculate the target. It's an adjusted plan from the amount you've delivered. For example, if you plan to produce 10 and you manufacture 5 and you deliver 5 into inventory, you can calculate a target for those 5 that you delivered, because it should be about 50% of the plan cost is where that comes from. So the status is very important in variance calculation, and target is another column that you will see appear when you're working with variance analysis in SAP. We've got 2 minutes to go, Jessica, on my clock. Anything else we need to go through here?
Sure. I think we've got, I'm just trying to go through any that you didn't answer during
I'm having a look too.
Presentation. Let's see. This one was asked earlier, but I'll go ahead and ask it again and see.
Please.
Those of you who want to put the answer in the chat, if you remember, how many variance categories are there?
We should see 100 chats immediately. And we did get one very quick. 8 is the correct answer for sure. 4 input, 4 output, you get extra bonus points for 4 input, 4 output. Correct. There's no 8 plus 1. There is 8. Rama. What we're referring to is the 8 plus 1. You might be thinking of something else. Yes, 4 input, 4 output is correct. So what was the, okay, just one quick question. What was the most common output variance? I did mention. We don't use output variances very much, except for this one is very common in manufacturing industries. Lot size variance, correct. Very good. Yes, it is correct. Lot size variance. The difference between the lot size that the cost estimate uses to calculate the costs on the cost estimate, correct. Well, thanks very much for everybody attending today. I had a very good turnout today and a very good participation by all the chats. I do appreciate that. And I'm sure that everybody on this call now has a much better understanding of product costing, cost object controlling, product cost planning. The terminology goes on, but the basic concepts we've covered in detail today. And if you want to email me any suggestions for future webcasts, please just let me know. We plan to have some more, I think, because we've got such a good response to this webcast. So thanks everybody. And thank you, Jessica, for hosting very much.
Thank you so much, John. And thank you so much, everybody, for attending today. Keep a lookout on our website for our June webcast. Bye. Have a great week.